Welcome back, everyone. Today on the Joseph Carlson Show, we're going to be discussing the death of Google search. That's the topic at hand. That's what everyone's talking about online. Google search is being disrupted. And many of you, in fact, the majority of you, believe it's in the early stages of disruption. When I ran a poll on X asking, do you believe Google search's moat is in the early process of being disrupted by LLMs, ChatGPT, Grok, etc., 56.6% of you said yes. 43% said no. Out of nearly 10,000 people polled, the majority of you believe that Google search is being disrupted. And this is also emblematic of the broader Google investor base. In fact, Google today is trading down. It's traded down a lot over the past month. Google's down 10.7% year to date. If we look just over the past 1 year, it's down 18% from its highs. It really hasn't done much over the past year as well. Google stock has trailed the market. The company today, even on a green day where the NASDAQ is up 0.7%, Google's only up 0.2%. It continues to not get a bid. It trails the market. When we look at the valuation metrics like the PE ratio, the price to sales, the free cash flow yield, Google stock looks really cheap. It looks undervalued. Yet investors continue to avoid this stock over the fear that Google's moat, their 93% market share in search, that moat is going away. It's being invaded by many competitive forces, the main ones being LLMs, ChatGPT, Grok, Claude, Llama AI. All these companies are coming for Google's moat. And it's not just retail investors or investors on social media that are concerned about Google. It's also in the numbers of big-time investors. You can take a look at these super investors. We have around 26 of them that currently own Google. And when I look through the trading history, we'll just see if you notice the pattern here. We look at the changes they're making to their portfolio over the past quarter. This was Q4 of 2024. Are the majority of super investors buying into Google, increasing their stake, or selling out of it? Well, you can clearly see that the huge majority are reducing their stake, some of them substantially, selling 50%, 35%, 20%. In fact, there are dozens of sales last quarter, only 2 purchases, dozens of sales. We go to 2 quarters ago, dozens of sales, there's a few more purchases, but it's around 2 to 1 selling Google. We go to 3 quarters ago, again, overwhelming action here is selling out of Google. 4 quarters ago, overwhelming action is selling out of Google. Going back to Q4 of 2023, the overwhelming action taken by super investors is to reduce their stake in Google. So we have investors on X and retail investors, many of you that believe that Google's moat is being eroded, it's being invaded. We have super investors continually reducing their stake in the company. We have the company today trading at a relatively low valuation and the stock continually flat. What do we do in this type of situation? Well, we're going to go over all of that. I'll put all of this in context as well as what I plan on doing with my holding. Because like many of these investors, I am invested in Google. It's been in my portfolio for a while. I have it in both the story fund and the passive income portfolio. It's done all right, but it hasn't been the best holding in my portfolio. And I'll show you my plans going forward with this company. So we have a lot to cover in this episode, and we'll be starting off by doing a quick overview of the fundamentals of Google. Because this company does not resemble the look of a dying company or one that's currently under threat. All the previous fundamentals, even the recent ones, don't resemble that. Now, looking at the fundamentals of Google, I think it'd be best to start off with a quick note about the valuation of the company. Right here, we have the PE ratio. Let me see if I can zoom in on this more. We have the PE ratio. This is the trailing over the previous 12 months. This is based on the next 4 quarters. And then this right here is next calendar year. So this is 2026. So Google trades at a 21 trailing PE ratio. That's based off of their previous earnings. Looking forward to this year, 2025, they trade on a 19 forward PE ratio. And then based off of next year's analyst estimates, in 2026, they're trading at a 16.6 PE ratio. Even looking at the most expensive of the 3, the company is cheap. But looking forward, which is probably more accurate, the earnings this year, because Google typically meets them or exceeds them, is very cheap. 19 forward PE ratio is not expensive at all. Then 2026's is also very, very cheap, 16 forward PE ratio. In fact, as an investor with the stated goal of wanting to outperform the S&P 500, one thing that I do is I take a look at these PE ratios, especially the middle one here, the forward PE ratio based on the next 12 months, and I compare that against the PE ratio of the overall S&P 500. I kind of compare and contrast like the S&P 500 as a singular company. Now, if the S&P 500 was treated as a singular company, where we combined and weighted all of its constituents and the corresponding PE ratios, the S&P 500 currently trades at a 22.5 forward PE ratio. So we have a 22.5 compared to Google's 19.09, which means just on this simple comparison that the S&P 500 is 18% more expensive than Google. So we're comparing the two as if they're two different companies. You're paying 18% more for the S&P 500's earnings than you would be for Google. Now, again, another exercise I do, this is just something that I think is a good way to compare your portfolio if your goal is to beat the benchmark, is if your company trades at an identical PE ratio of the S&P 500, let's say you own a company that trades at a 22.5 PE ratio, that company, in order to outperform the index, would need to grow its earnings per share faster than the index. That's a very simple way of doing the math. If it trades at the same starting multiple, to outperform it needs to grow earnings per share faster. Now again, Google's at a cheaper multiple than the S&P 500. It's around 15% cheaper, or another way of phrasing that is the S&P 500 is around 18% more expensive. Either way, Google's at a lower starting multiple, which gives it an additional potential avenue of outperformance. If you start at the same multiple, the only way to outperform is by growing faster. If you start at a lower multiple like Google, you have that route as well. You can simply grow faster, or you can grow the same speed, but have it be re-rated back to the same multiple of the S&P 500. Meaning that if over time, Google ends up growing identically to the S&P 500, but it simply starts to trade back at the same level, back at the same multiple, because investors become slightly more positive on the company, then it outperforms the S&P 500. So Google has two ways to outperform here. Outgrow the S&P 500 and still trade at the 19 forward PE ratio. That would beat the S&P 500. Or grow at the same speed as the S&P 500, but be re-rated back to the same multiple of the S&P 500. That would also outperform. Now, if it does both of these things, if it grows faster in earnings in the S&P 500 and investors get more bullish on the company, re-rating it back to the same multiple of the S&P 500, that would be substantial outperformance. That is both of these factors coming together to have an alpha stock. So there is opportunity here. And again, looking at the fundamentals, when we just look at what's going on with Google, this does not give the appearance of a dying company. Take away the stock price here for a minute. We have Google on a trailing 12-month basis growing revenue by 13.81%. If we look at this just in the most recent quarter, so the most recent data available, it grew by 11.77%. That's in double-digit territory for a company this mature and this big. That's still very fast revenue growth. Now again, we're going back to the trailing 12-month revenue growth here, and we can see it diversified across Google's different business streams. Search is one questionable part of the company, but if we look at search, it makes up today around 50% of the company. So it's a massive chunk, super important, but you also have a lot of different businesses that are very high quality businesses. We look at YouTube ads. YouTube has continued to grow substantially. I think YouTube is one of the crown jewels of different companies across the world. Try to think of a better video company in the world. There's basically just Netflix, maybe Disney, Amazon Prime Video, but YouTube is even more unique, even has a better moat than any of those companies. YouTube continues to grow double digits. In fact, 14.7%, roughly 15% year over year. We have the subscription business. This is like the Google One membership, their photo upload, all the various things that Google gets people to sign up for that they never cancel in the future. Google has a million different subscriptions, and they have hundreds of millions of people on these subscriptions. Then we have Google Cloud, which I've continually talked about as the best part of Google today. It's the significant growth driver. It's growing at 31% year over year. And while the Google Cloud is growing, the operating margins or profitability on that cloud is also increasing, up to 17.5% in the past quarter. Google's also doing things to optimize this, make this part of the business more profitable. So Google Cloud is now a more meaningful portion of the business. Now we get to the other bets category. And this is a small portion of Google. In fact, it's basically just like a speck in the grand scheme. So it's very small, but it has a lot of potential. When we look at what's going on with other bets, there's one segment of this that's really important. That's Waymo. Sundar Pichai, the CEO of Google, posted about how Waymo exceeds now over 200,000 paid rides per week. Now, that number may seem small, 200,000. We have companies like Uber doing multiple billions of trips, billions of rides every single quarter. So Waymo, in comparison, is tiny. It's barely non-existent at this point, but it's growing rapidly. And that's how these things start. They start small, they perfect what they're doing, they get the recipe down, and then they rapidly scale. We've seen that before with restaurants. Restaurants start small, just a couple locations, but over time they open up hundreds of new locations across different cities, and before you know it, they're a big, nationally recognized brand. I can see the same thing potentially playing out with Waymo. I retweeted this and put that Google started Waymo with paid rides being around 50,000 per week about 7 months ago. Then they gave another update that it went from 50,000 to 100,000 rides per week 4 months ago, then to 150,000 rides per week 2 months ago. Then about 3 weeks ago, the last update then was around 175,000 rides. And then currently, the most recent update is 200,000 rides per week. They've around 20x the amount of rides they're doing per week over just the past 2 years. So it's the rate of growth. Waymo is scaling across different cities. They're targeting the most densely populated cities. And that makes up this other bets business line. It's not really impactful to Google today, but it has huge potential. Tesla investors are always talking about the potential of their robotaxi network. Well, Google has part of that embedded in their business. They actually have the proven model working today, accepting rides, taking people from point A to point B safely with no driver. It's incredible, and it's actually operational. So even though it's just a small part, you don't need to factor it into your overall Google thesis. It's not a requirement to work out for Google to be successful. It's something that's like a little call option for Google. So the businesses outside of Google search in and of themselves are very good businesses. Google is diversified into all these separate crown jewels. Cloud business is great. Subscriptions are great. Other bets with Waymo has huge potential. So far, it's looking very promising, and you know how I feel about YouTube. Then we have Google Search. This is the portion of the company that's under question. It's a high margin, incredibly profitable, massive portion of Google. Now again, when we look at quarterly and we just look at Google Search, to see the most recent data, just the past quarter, Q4 of 2024, to see the damage being done to the search business, it grew 12.48%. That's really fast growth. Again, that's fast even compared to its history. Google search is actually growing unusually fast. You'd expect a slowdown in search, even not talking about LLMs. So right now we see this business continuing to grow. And this is the difficult part about the question of disruption of this Google search business, is that so far we haven't seen it in any of the numbers. Everything looks like it's business as usual. And again, I can show you the other metrics here. We can look at virtually any of them. If you're a fan of EBITDA, maybe you aren't, but if you are, that's growing quickly, 34% year over year. You see the trend there. It had a little bit of an ebb and flow in 2021. Many companies did, but EBITDA is surging to all-time highs. The free cash flow looks questionable. It's flattened out over the past couple of years, but to put this in context, free cash flow is a calculation of net cash from operations minus capital expenditures. And we know what these big tech companies have been saying and what they've been doing. They're investing substantially into artificial intelligence with their cloud business. So the free cash flow is flat over the past couple of years, but that is not because operating cash isn't growing. It's because the amount of CapEx is increasing substantially. Take a look at the CapEx. This is a business investing in its future. CapEx has gone up double over just the past year. So Google says we have too much demand. We have too many people wanting our servers, wanting our GPUs. We're investing in that for the future. When we look at net income, it's at all-time highs, growing 36% year over year. When we look at the earnings per share, this has grown 38% over the trailing 12 months year over year. Last quarter, it grew 30%. And this is a company that trades at a below 20 PE ratio, growing earnings 30%. Again, this is not the graph that you would see typically with a company with lots of commentary about it potentially dying or being massively disrupted. Google holds around $95 billion in cash, so they have a lot of cash. They're paying a dividend. They're returning a lot of capital through buybacks and dividends now. They've returned roughly $70 billion over the trailing 12 months. So they're paying back investors a lot of this cash flow. And the shares outstanding for the company have been in decline since 2018, which is a good thing. This is one of the rare charts you want to see the red hair. You want to see these numbers go down. It means that current shareholders own more of the company. And while all of this is going on, the ratios that you would typically look at to determine whether or not a company is making profitable investments are going up. The return on capital employed is now at 31%. Gross margins continue to increase over time to 58%. Operating margins to 32%. Profit margins up to 28%. There's nothing you can find in the income statement, the cash flow, the balance sheet, the commentary, the ratios, even things that management say in the earnings transcripts of the company calls should cause alarm. Everything looks overall very positive. So you're looking at a stock here that all the data looks really good, but investors are overall concerned. And like many investors have pointed out, just because a company looks good in the past doesn't mean that that won't suddenly end. That's how things evolve in life. You may have a feeling of security or certainty based off of all these numbers, but you have to factor in dynamic changes that are happening. In fact, one commenter posted that these are things of the past. They're things that have already happened. They don't speak to the future of the company or potential threats. In fact, this is like looking at the healthy life of a turkey. If you look at the graph of a healthy life of a turkey under care of humans, it looks a bit like this. Now, it goes up. The healthy life of a turkey seems to do really well until it doesn't. And this is a take straight from Nassim Taleb going over black swan events. He says, quote, "Consider a turkey that is fed every day. Every single feeding will firm up the bird's belief that it is a general rule of life to be fed every day by friendly members of the human race, looking out for its best interests." So as humans are raising turkeys, we're feeding them up to fatten them. In the turkey's mind, the logic they see is that these humans are friendly and they're feeding them. They're getting fed, they're getting fat, and they're enjoying that. And every single day that this goes on, the turkey's further convinced that humans are friends because they fed them every single day up until they didn't. On the afternoon of Wednesday before Thanksgiving, something unexpected will happen to the turkey. It will incur a revision of that belief. And this is the predicament of risk. The feelings of safety that this turkey had reached an all-time high at the worst possible time. And this may cross over to investments. What if right now, investors feel really good about Google because of all the earnings and cash flow and dividends and buybacks that it does, because of the incredible diversified business, but we're not looking appropriately at the risk of LLMs and this potentially damaging dynamic change that may happen. So even though everything looks good in the past and we found ourselves a great company, historically a compounder, has given good returns to investors for a long period of time, it's still incredibly important to be forward-looking and to do credible analysis on potential threats to Google's business. And that's what I want to look at with LLMs, with companies like OpenAI, with ChatGPT, or with Grok, this new search engine. Both of them pose what I believe is credible threats to Google's moat. One investor to raise the red flag on this and potentially point out problems with Google was Brad Gerstner from Altimeter. He went on to CNBC over a year ago and gave this interview.
The second half of this year, and you were bearish. I heard you on a podcast the other day. It sounds like you haven't changed your tune on Alphabet. What is your big concern? If you when you talk to shareholders in Alphabet now, is it that they don't have the lead position in AI and that all of a sudden search is going to get away from them, or is there something else? Because that likelihood seems really slim to me.
Okay, so Josh, here's my fundamental position. Search is going to be replaced by agent-led information discovery. I see it every day. My 15-year-old son says, "Dad, I don't use Google anymore. I just use ChatGPT." I talked to 2,000 people at the Javits Center. How many people have used ChatGPT instead of Google over the course of the last 2 days? 1,000 hands in the room go up. I asked my analysts who are sitting on their desk. They're replacing their use of Google with ChatGPT. We are having a fundamental structural shift in how people retrieve and discover answers to the questions they have. So Google is going to have to compete in this new thing, okay? Meta's going to compete, Apple's going to compete, Microsoft with Copilot, ChatGPT, etc. There are going to be 6, 7, 8 incredible competitors there. Google will be one of those competitors, and let's assume that they're a very competent competitor because they have all of these assets. The question to you, what do you think the likelihood is that they're going to reconstruct as dominant of monopoly in this new thing as they have in search?
So
facing the innovator's dilemma, facing the cultural challenges they have. I would just say, as an investor, Josh, and I have a ton of respect for you, the discount rate that you need to apply to this investment is much, much higher today than it was 2 years ago. 2 years ago, there was no challenger. Google was the only game in town. Now we know search is being replaced with a new form of information discovery. And all I'm saying is, even if they emerge as the leader in this thing, they will not have as much share of the pool of profits as they have in search. It's almost impossible for me to see how they replicate that.
In this interview a year ago, Brad Gerstner gave a great overview of the challenges investors are facing today with Google, the big considerations. The advancements in these LLMs is incredibly impressive. And he mentions that Google's going to have a difficult time keeping the same market share in this new form of finding and attaining information that they have previously. Now, another thing that he mentions in this interview is that he believes when you're doing analysis on Google and doing discounted cash flows, the discount rate that you apply to Google should be much higher, which of course you would do to account for increased amounts of risk. If a company is becoming riskier, less predictable, the future seems more unknown, you would apply a higher discount rate to compensate for that risk, which is another way of saying that Google should trade at a cheaper price than a more predictable company. Now, how have things developed over the past year? Well, over the past year, since that interview itself, LLMs have gotten a lot better. They've been used a lot more. More people are finding out about them. More people are becoming impressed by them. In fact, one thing I just looked at today was I simply went to the App Store, in Apple's App Store. I looked at the top free apps. You might notice something there. ChatGPT is number one. It's been number one continually. Every single day, every single week. For years now, ChatGPT is the top downloaded app. ChatGPT is the leading LLM in terms of distribution, and the company remains at the very top of the most important app store for over a year. Not Gemini, not a property of Google, but another company. Another thing that's happened is not only are more people finding out about LLMs, downloading things like ChatGPT, young and old, everyone in between's finding out about them, word spreading, but they're also just getting a lot better. ChatGPT 4 has been at kind of the same state, so most people are aware of ChatGPT and its capabilities, but LLMs today are getting better and better at a rapid pace. And the most recent models of leading LLMs are incredibly impressive. One of the big advancements that came recently was the release of Elon Musk's new XAI Grok 3. Now, we've had Grok for a while. It's an LLM that didn't get a lot of attention. It was well behind ChatGPT and other leading LLMs, but Elon Musk has been working hard on this. He has a huge team of developers on it. He has 100,000 GPUs in this huge warehouse. They've spent a fortune on building this thing, and he did this live stream talking about the new Grok 3.0, that it was super fast, super impressive, that it benchmarks really well, and then he released it. Me trying this out, I must be honest, was the first time that my sentiment towards Google search got lower. It was the first time. I looked at the capabilities of this, and it was so much better than Google that it's not even close. That people finding out about this will immediately recognize it's superior to Google search in not every way, but almost every way. It's so much more capable. It's so much faster. It's so much more concise. Even with Google's Gemini integration, Grok today is much more powerful. Let me give you a couple examples. One thing I wanted to figure out recently is if this guy named Bobby Kogan is conservative or liberal. Now, there's nothing particularly notable about him. He just writes about economic policy and about economics. So I just wanted to know his background and kind of what standpoint he comes from. So I searched his name and whether or not he's liberal or conservative in Google. The search term I used is Bobby Kogan liberal or conservative? And we have the Google search results here. A bunch of different links and information about this individual, which normally I could go in and kind of see what he's worked on, his past, his perspective, and try to piece that together. It has some bolded parts. It says that he works at a American Progressive Center, a left-leaning think tank. So right there, I can deduce that he's probably more on the liberal side, but I have to kind of dive in and do this myself. When I type this same question into Grok and I hit enter, this is what Grok provides me. It automatically scours the web, searching 20 different web pages, and then it comes to a consensus. If we look at what it does here and just read through this, you can see the advantages of this type of search engine. Bobby Kogan's political leanings can be inferred from his professional affiliations and work, though he does not explicitly label himself as, quote, liberal or conservative in public statements. He is the senior director of the federal budget policy at the Center for American Progress, a well-known left-leaning think tank that advocates for progressive policies. His career includes significant roles in the Biden-Harris administration, such as advising the Office of Management and Budget on initiatives like the American Rescue Plan and Inflation Reduction Act, both which align with Democratic priorities. These associations suggest that Kogan's policy perspectives are more aligned with liberal and progressive ideologies, particularly on economic and budgetary issues. That said, his expertise focuses on technical aspects of federal budgeting, spending, revenues, deficit, and debt, rather than overtly ideological stances. His arguments often emphasize pragmatic outcomes, like reducing deficits or prioritizing aid to vulnerable populations, which could appeal across the spectrum but are typically framed with progressive context. Without direct statements from Kogan declaring himself liberal or conservative, the evidence from his affiliations and work strongly point towards a liberal orientation. This is a great, nuanced, balanced perspective overviewing the topic, giving me a concise but informative answer on this subject. Now I know a little bit more about his context, what background he comes from, and it doesn't overtly label him as a liberal, it just says that it might point that direction because of his history. Compare the answers between the two. Grok is way better here. It's not even debatable. When I'm looking for this answer, Grok gave me the answer in a very good way. Google gave me a bunch of links and said, do the work yourself. Just as a part of normal human behavior, when you type in a question and you get those two different types of answers, which service do you think you're going to come back to? Which one do you think you're going to want to use in the future? The one that provided you with a bunch of links, or the one that provided you with a concise answer specifically to your question in a great format? This is part of the issue that Google's facing. Once people use these tools, they become immediately infatuated with them. They fall in love with them almost immediately. Another example I could give highlighting the differences in capabilities is simply asking different questions that require some level of deduction or some level of judgment. For example, I can ask the question, is S&P Global or Moody's a better buy today based on the different stocks and what they're doing? Simply put, which one is a better buy? I type that question into Google, and like you'd expect, I get similar questions, so it's prompting me for different ways to phrase the question. I get a link to some analysis going over it, which is a better buy between the two. I get the value investing Reddit subreddit. I get a bunch of different websites that might compare them financially, and that's about it. A bunch of links that, again, I'd have to go through and try to piece all of this together. When I look at the same type of question with Grok, I can hit something here called deep research, and then I can search the same exact question. I'll copy it in, no different than in Google, and let's see what Grok does. You can actually see it thinking about the question. It starts analyzing the comparisons here. We're browsing through S&P Global records, earnings reports, financial statements. We're browsing and scouring all across the web. It says right here that it's referencing 40 web pages, and Grok has an advantage where it goes into X and it actually looks at X posts. In some cases, it'll even do analysis where it references some of my own Twitter posts. But either way, it has some time period here where it's thinking about it, but it's kind of like a progress bar. It shows you what's going on. The way that this works is Grok right now is acting like an agentic search engine. In fact, instead of me going out and searching in Google, it's basically doing that for me. It's going out like an agent, searching all these different articles, using its LLM to quickly analyze them and see if it has pertinent information for the deep search that I'm doing. So this agentic layer of AI search is the new iteration to finding information about a particular topic. And you just see it going through all the logic here. It's incredible. Then we start to get the report here. This is everything that it's got through, thought through, all the different transcripts, all the different pages, and it builds out a compiled report from that. We have tables that it's building out where it measures the two different companies from each other, and then it has key citations that it lists. It gives you all these different overviews, financial performance, history of the company. You have segment analysis. For example, it breaks down S&P Global segment, breaks down Moody's business with Moody's Analytics and their investor services with their credit rating. So you can learn about these two companies in comparison and contrast to each other. Not everything it says I agree with. I think some of the conclusions it comes to are wrong, but that's only because it gathered information of other people's conclusions that I don't agree with. And that'd be the exact same thing if I dug through all these different pieces of information myself. If I went to Reddit value investing, I'd also have some people I disagree with. So it's not the perfect summary that will always fit with what you're doing, but it gives a very comprehensive overview of the different companies, or whatever subject you're looking at. You can have it do a deep search about any medical question you have, and it will give you a detailed overview referencing all these journals and studies and everything about it. This isn't just applicable to investing or these specific use cases. This thing is incredible in a lot of different ways, and people are finding out about it. Now, I could go back and forth giving more and more examples of LLMs doing incredible things, offering far more value with lots of information searches than what Google's currently offering. Even with the integration with Gemini, it just feels lackluster compared to what you're getting with things like Grok or ChatGPT or any of the leading LLMs. They are far more advanced in their capabilities than simple Google searches. Now, I say this as someone that owns Google Search. There are going to be a lot of people that do a lot more searches in Grok, a lot more searches in ChatGPT than ever before. It's going to continue growing at a remarkable pace. What these CEOs are saying, that they need more capacity, they need more server capacity, GPUs, is true. As more and more people use these powerful search engines, they're going to be powered more by expensive GPUs. So it makes sense that all of them are spending so much money on building out infrastructure, cloud hosting, GPUs to run all this advanced AI logic. This isn't going to just be used with search engines, it's also going to be integrated into all different websites. But either way, right now, I strongly believe that this is going to take some market share from the market share pie of people wanting to find information. They're going to find it through LLMs. It's not just going to be through Google. And I say that as someone as a Google shareholder. There's going to be a lot of growth in this territory, a lot more people using LLMs in the future, especially when they get down the voice where you can just talk to it and converse with it. That's also going to be massive. The big question I have now is the growth of LLMs and things like Grok eventually mean the death of Google search, because that may not actually be the case. There might be some scenario where these type of things grow, but not necessarily at the expense of Google search. Maybe their growth isn't as much of an overlap as we think. Maybe people using Grok and LLMs and ChatGPT aren't necessarily lost customers for Google or Google search. That's a question that I've been looking at over the past month. And I think this comes down to a question that I've been asking for a long period of time. A question about the basic assumptions made on Google search since the beginning. The assumptions made so far is that Google search has had this dominant monopoly in information, in searches. And that's a premise that I don't know if I fully believe. I've questioned this for some time, but I'm not convinced that Google search has ever been a dominant monopoly. I think they've always been highly competitive with many other opportunities to find information, to find products, to find things to search. For example, the way that analysts look at the search market is basically like this. If we look at Statista here, one of these websites, you have Google search right here with their 93%, 85%, right? They have this market share, but market share all comes down to how you define the market. For example, the way that all these analysts are defining the market is through Google, Bing, Yahoo, DuckDuckGo, and then 2 Chinese search engines. That's the market that Google search competes with. And that's what's been relayed over and over again for the past 10 years. Google has this nice 90% market share of the search industry. So again, we have this defining of the search market share, and we have it repeated all over a place. You've seen graphics like this, 92% market share for Google. Bing has 3%, and then we have other ones mixed in there. But Google basically owns the world with the search market. But this is a premise that's frankly just wrong. The way that these analysts have carved up the market share for Google is wrong. This isn't an accurate reflection of reality at all. People just accept it for some reason. They say, oh yeah, there's the Google market share. If it's on this nice pie chart, must be true. People accept it because it's in a nice chart here as well. Google has 90% of the search market. None of this is an accurate reflection of how humans interact and how we've searched in the past. This is just a way of analysts trying to carve up a market in a very arbitrary and I think incorrect way. For example, one of the biggest search engines in the world is owned by a company called Amazon. Amazon owns 50% of the shopping business online. Amazon has a massive, wide, tall search box at the top of their website where people every single day, they get on their app, they get on their desktop website, and they search for products, they search for different things to buy, and they buy them. How is that not competition to Google? They own a dominant website with a dominant search box that sells hundreds of billions of dollars worth of product every single year. Google has tried to make money selling products online as well. You can search products through Google and get ads and different things for different products or affiliate links. Google earns money through those search results. So Amazon has been this competitor to Google for decades. Amazon for over 20 years has been competing with Google fiercely over search, over clicks, over sales. But yet for some reason, the search market doesn't include Amazon. Well, why not? Amazon faced them as competitors when they were small. Amazon continued to grow, taking more and more search volume. If you look at the traffic that Amazon has on its website, it's grown immensely. Amazon, by every reason possible, is a huge competitor to Google when it comes to search. Products are a huge part of search. It's a major category that Amazon owns. Take a look at some of the other competitors to online search with products. You have search engines that only make up 42% of product results in and of itself. You have Walmart, you have YouTube, which is very much a search engine. People search questions in, they search for products, they search for reviews, they search for content, and they get results. That is very much a search engine. That's one that Google owns. So you could combine that with Google's overall market share. Then we have Facebook, Instagram, TikTok. Now, this isn't even the only ways that people search. There's many more. The amount of websites that people go to where they search for information and they find different pieces of content, they get fed ads, they find products, is substantial. Not only do you have Google and YouTube, which Google owns, you have Amazon for products. You have Reddit, which people are searching in all the time, one of the most popular websites in the world. You have Pinterest, which people searching continually for visual-driven stuff. You have Quora, which people search in for questions and answers. You have Wikipedia. You have TikTok, which people continually go to more increasingly now for different tips, DIY stuff. You have Instagram, which Meta owns. That is very much a search engine. You have Facebook, which again has another search engine in it. One of the top things on the Facebook page is a search box people go to. They search and they find communities and posts and people. You have Twitter, you have Yelp, you have TripAdvisor, you have Goodreads, you have WebMD, Lifehacker, Wirecutter, Consumer Reports, Etsy, BuzzFeed, on and on and on. All these websites have search boxes that people use daily. But none of these companies are ever counted in towards the search market share. So the entire premise that Google has had at any point in time, this dominant 90+% market share of search, is in many cases wrong, and it's a wrong premise to begin with. Google has always been highly competitive with many other websites, some of them large and small, with search market share. So we have another predicament or question for Google investors, and that is LLM searches just another way of competing with Google where Google will grow alongside it, or will it actually replace Google searches? Here's how I currently view this playing out. This is my thoughts of the future, and there's no guarantees if this is how it will work, but this is how I think it's most likely to work out. I think LLM searches are very powerful. Having these AI agents that can compile all of this data and give you a nice write-up, I think is just an incredible tool, and it's going to grow substantially in the future. I think this is going to be a huge way of information gathering, learning about subjects, and all of that type of stuff. So LLM searches, I think someday, in combination, could be bigger than Google search today. There is an increasing demand and growth of information gathering, demand for people to want to know about things that will continue its long-term secular trend into the future. As more people get internet connections, as more people become educated, they'll use this type of information gathering. But I think the overlap with Google search in particular, there's some overlap, but I don't think it's a full overlap. I don't think LLM searches completely replace everything that you do in Google. In particular, Google is the king of local searches. Anytime you want to know something about a restaurant around you, movie theater times, anything going on around you, people have a strong preference for Google search. LLMs aren't really great on that front. They're good at scouring through the internet and doing write-ups, but they're not good if you want to know what time a store closes. They just don't have the same local information. Google has monopolized that type of local information. They've integrated it into maps. They've integrated it into all different aspects of their business. And that's still very valuable. I think that's going to be very difficult for LLMs to take that aspect of the company. And that local information also, I believe, has a huge portion of the ad revenue that Google gets. So I think it's going to be true that LLM searches will take some different questions and queries that would go into Google search normally, But I also think that LLM searches simply just expand the capabilities of people's searches. They build upon it. They make it so that there's a whole new category of searches that didn't exist prior to now. Overall, I believe that Google is in a position that even though LLMs are incredible, they're impressive, they will take some market share here from some searches, I think overall, investors may be surprised that Google search continues to grow, that the revenue of it continues to grow. It might have some ebbs and flows like Meta does with advertising dollars, but overall, the organic growth of wanting to organize the web's information is still going to be valuable. And the use cases from Google search and LLMs are still different. LLMs are great, they're powerful, but they are different. So I think when looking at Google stock today, the risk has increased for this company. I do think it's slightly less predictable than it was a couple years ago. My sentiment has changed slightly more to the negative when looking at Grok, but I also believe the company, still with all of that factored in, is undervalued. The stock is already priced for this poor sentiment. It's trading as though it's already dying, while it's still growing faster than the majority of companies in the market. And this is the type of scenario that these companies get into frequently, where they end up having excess returns, far above the market. I think that's the most likely outcome from here. That's been the case every single time people have talked about the death of Google, which they do continually. We saw it happen in 2022. People talked about the death of Google, the stock went up. We see more dips along the way, the stock goes up. We've seen it all throughout history. When investors overwhelmingly become bearish on this quality of a company with this many assets, unless this is the time that Google really does get hugely disrupted, the stock will continue to go upwards. So as of right now, I am still holding my position in Google. I haven't sold any shares. I'll take a look at this company again when it's above $200 per share, $210. I might take some gains off the table at that point, but as of right now, I'm fully invested. So that's my thoughts on it. Have a good weekend. See you in the next one.